You know, for almost 100 years, the name Raymond meant one thing: suits. But right now, there's a huge transformation happening. A brand new company has been carved out of the old one, and it's carrying that legendary brand name into a totally different world: real estate. So the big question for any investor is pretty simple. Is this the beginning of a new empire, or is it going to be haunted by the ghosts of its corporate past? Okay, let's get into it.
So on one hand, you had the old Raymond Group. Think textiles, suits, a bit of everything really. A classic conglomerate. But on the other hand, you now have Raymond Realty, which is all in on one thing: real estate. This wasn't just some new side project, this was a complete strategic pivot. You could call it Raymond 2.0, and the whole idea was to unlock the real value of its different businesses by separating them.
So how did they do it? Well, it was through a strategic move called a demerger. The company basically spun off its real estate division into its own brand new company that trades on the stock market. The whole point was to give investors a really clear choice and let the real estate business finally be valued on its own massive potential. And it all became official on July 1st, 2025. That's the day Raymond Realty started trading on the stock market. But here's the thing. It didn't start from scratch. No way. It inherited probably the most valuable asset of all, a brand that people have trusted for a century, now attached to what's likely the biggest purchase anyone will ever make: a home.
Okay, so this brings us to the bull case, the argument for why this new company could be such a huge deal. Why are so many people in the market excited, even though it's a new listing? Let's break down its core strengths.
Their growth strategy is really smart, and it comes in two parts. First, they're going to develop this huge chunk of land they already own. We'll get to that in a second. Second, they're expanding using what's called an asset-light model. Instead of spending a ton of cash buying new land, they partner up with other landowners. This makes their growth way more efficient with their money.
At the absolute center of their strategy is one number: 100. That's 100 acres. This is their crown jewel, a massive piece of land in a prime location, Thane. This alone gives them a huge built-in runway for projects for years and years to come. So what could that 100-acre piece of land actually be worth? Well, the potential is just staggering. We're talking 25,000 crore rupees in potential revenue. And get this, that's all from just that one piece of land that they already own. It's an incredible future pipeline.
And remember, that's just the land they own. When you start adding in all their partnership projects, that asset-light model we just talked about, the total sales potential just explodes to an estimated 40,000 crore rupees over the next 5 to 7 years. It really shows you the scale of what they're trying to do.
And they're not just some startup either. Raymond Realty is already the #1 player in its home base of Thane. They're a top 5 developer in the entire Mumbai region, and they're already making moves to expand into other big markets like Pune. So they have a really strong foundation and a clear road ahead for growth.
The strategy seems solid, right? And the numbers, well, they're staggering. But you know, every story has two sides. So you have to ask yourself, is this plan really perfect? Or are there maybe some cracks starting to show?
And that, of course, brings us to the bear case. To really understand the full picture, you have to look at the downsides. So let's unpack the risks, the tough competition, and yeah, that historical baggage we mentioned right at the beginning.
First thing you have to know, the Mumbai real estate market is an absolute battlefield. Raymond is going head-to-head with giants like Lodha, Godrej, and Oberoi Realty. The competition is so intense that developers are doing things like waiving fees and offering crazy payment plans just to get customers in the door. And that puts a real squeeze on profits for everyone.
On top of that, you've got risks that hit the entire industry. Real estate goes in cycles. If the economy slows down, so does the housing market. Then you've got things like government regulations causing delays or the price of steel and cement suddenly shooting up. All of that can mess with timelines and profits.
But honestly, the biggest concern for a lot of investors isn't about the market at all. It's about the company's past. And this isn't just gossip. This is a direct quote from a 2020 ruling from SEBI, India's market regulator, about the parent company. This finding, that it failed in corporate governance, is exactly the kind of historical baggage that casts a long shadow.
So, with this new company, investors are keeping a close eye on a few specific red flags. Promoters pledging millions of shares is a big one. It's basically like using your company's stock as collateral for loans, which can be risky if the stock price drops. And when you add in those lingering concerns from the parent company about things like executive pay and who's going to take over next, you have a list of issues the market just hasn't forgotten. So you've got this incredible growth story on one side, and these really serious governance questions on the other. It's a classic tug of war. Let's take a look at how analysts are weighing these two sides to come to a final verdict. So even with all the risks, the numbers looking forward are really strong. Analysts are projecting some pretty healthy growth rates, around 20% for revenue and nearly 16% for net earnings, each year for the next few years. The growth engine is definitely expected to be firing on all cylinders.
Now this slide. This is where you can see how the market is thinking about all this. Just look at the valuation. Its competitors are trading at an earnings multiple of around 17, but Raymond Realty, it's valued closer to 13. That gap is not an accident. That's what analysts call a governance discount. It's the price the company is paying for the market's memory of its past.
So what's the bottom line here? Well, the general feeling from analysts is a buy. But, and this is a huge but, it comes with a condition. It's really a recommendation for long-term investors who can see that huge potential upside, but who also fully understand and are willing to accept the risks that come with its history.
And really, that leaves us with the ultimate question, one that any investor has to answer for themselves. Raymond Realty has a new, focused company structure and a really bold, clear vision for its future. But is that going to be enough to finally, truly overcome the ghosts of its corporate past? That right there, that's the multi-billion-dollar question.